What's up and what the hell is going on with tariffs? One day they're on, the next day they're on pause. The EU wanted to make a deal and now they want to fight back. Tariff policies are flip-flopping so much, I thought Donald Trump picked up a weekend shift at the IHOP. He's out here stacking policies like pancakes. Yesterday it's tariffs forever, today it's never mind, go buy the dip. Everyone's talking about tariffs, but nobody agrees on what's coming next. So we're going to ask the question, what if they go away? What if they stay forever? And what if this is the start of Cold War II? Welcome to the Clear Close, and today we're going to do what I used to do back in my corporate days, which is something called scenario planning or running simulations. It's kind of like military war games, but we're going to narrow it down to mortgage rates and real estate. We're going to walk you through 3 possible and very likely tariff scenarios, and then the 3 of us will break down what each of those scenarios could mean for your home value, for the real estate market, and for rates. Quick disclaimer, we're not economists, we're not hedge fund managers with billions under management, but we do listen and hear what those people have to say. And we've done quite a bit of our own research in preparation for this episode. We're connecting the dots and inviting you to join with us on this thought experiment. All right, let's get into it. Joining us today are Jason and Nikki, co-founders of The Clear Close. Hey guys.
Hello.
Morning.
Hi, everybody.
Hey, everybody.
All right, so we went over the ground rules offline, and we're going to go over it one more time for the audience. We're not making any moral judgments or arguments for or against the tariffs. This is a simple thought experiment, a business exercise. We're going to try to keep the emotions out of it, and we're going to keep it narrow. Real estate and mortgage rates only. Obviously, tariffs are going to have a huge impact on every aspect of our lives in the economy, global, domestic, whatever, but we just want to keep it at home. All right?
Cool.
Sounds good. Okay, here we go. Scenario 1, all of the tariffs get rolled back. It was truly just a negotiating tactic. He got everything that he wanted and no more tariffs. So in that scenario, what could potentially happen? What's the domino pieces that are going to fall?
I mean, I think it's going to be positive. That's going to give more confidence to like the US. So rates, I would say at that point should drop a little bit, you know, but that also too should signal people to actually want to buy. I mean, you know, we always say, as long as you qualify, buy the house. But at that scenario, I would say that's what, you know, that would be good. That would be good for housing.
Yeah, I agree. It's more predictable having a market where what we've been accustomed to for the last like 50 plus years of almost free trade across the globe, right? So it's when it becomes more that when you go fall back to that, people know, the investors know, manufacturers, consumers, they're going to be able to proceed as before. So when it becomes more stable in that sense, it's easier for people to feel safe and go out and buy a home, right? Because they know their job's still going to be there. Well, if it's a negotiation tactic and that's where he's going towards, I think it's going to bring consumer confidence back.
Nice. Okay, so I think there's going to be, obviously the stock market's going to come roaring back, right? Which means risk on environment. And if it's a risk on environment, treasury bonds, prices will go down, which means, correct me if I'm wrong, if bond prices go down, yields go up. And when yields go up, that means rates go up too, doesn't it?
That's correct.
But because there's no tariff, like that's the whole issue the last like 2 weeks, because, you know, stock's been dropping dramatically the last 2 weeks, but then we've seen our rates going higher. And that's because of inflation that tariff brings. So then actually, you know, if he eliminates that factor, it's basically going to actually make rates drop.
So would you think that demand increases because there's more certainty in the market? So there's going to be more buyers coming in. Wouldn't that like push up the prices of homes?
Well, I think the demand, it's going to come with, certainty, right? Because people are not going to buy as much if they're not certain about their job being there. You know, they're not certain about like the economy. But if that simmers down and they're back to their norm, that's going to basically motivate them to move to the next step, to buy a house. So in that scenario, definitely, like, I think it's going to push them to want to buy.
So this hypothetical scenario you're talking about, Peter, is like 6 months later, it's November, December, later on in the year, and we know that the tariffs are fully rolled back, right? With some level of certainty. Yeah. In that case, I agree with Nikki, because at that point, you know you're going to have your job still. You know what cost of goods are. Like we're going to have seen the fluctuations probably on like household goods. Eggs hopefully are back to normal, and then you can buy your house, right? So I would say if this is my primary home and not an investment, I treat it as a completely different thing, because if you're in it for the long haul to invest versus in it for a roof over your head, it comes down to like what you can afford to pay and you're comfortable with, because that's going to dictate, should you buy a house now?
Let's go move on to scenario 2. The US is going to maintain elevated levels of tariffs for a prolonged period of time. So like, let's say Donald Trump says, you know what, I truly believe that tariffs is the way for the United States to actually make money. And, the next administration, whoever it is, the next president, Democratic or Republican, they also believe the same thing. Um, I don't know how likely this scenario is, given the past week of what we've seen, the
Or
flip-flopping,
day.
or day even, right? But let's just say something like this happens where some level of tariffs, whether it's a baseline 10% or it's like 10 plus X percentage for each country, right? Like that level still maintains for a long period of time. Long meaning more than 4 years. So what will happen to our industry if that happens?
Well, builders are going to come to the crossroads of it's too uncertain to build, right? So if I don't have a profit margin I can hit to keep this business going with all these employees, right? Because like a lot of it is labor costs. So it's like, if I have no idea what my inputs are at this point, and it can be up to 100% or 400% of what my initial calculations are, they're just not going to build. It's not worth the risk.
Actually, in this situation, I'm actually adding a second story to my house, and I am starting literally next week or the week, yeah, the 21st. My contractor is going to come in and actually start demolishing, and this happened. It truly freaked me out, because now I actually, like, called text him the other day. I'm like, should we just order everything that we can right now, because we've seen it in COVID time where lumber went up so much, and people think they were going to get a house, their renovation done at a certain amount, and then it became double. And right now I'm freaking out about that, because my price could double just from what I'm doing. And that's a huge budget,
Get an invoice breakdown. At least that way you know like what your labor cost estimates are, and then what your material costs are. And then at least you could try to keep an eye on it. Or like you said, like I think it was smart what you told him. Like if there's anything you can order now that you know for certain you're gonna need, just order everything up front. That way you don't have to worry about surprises later. Lumber, like I've seen framing costs go from like 75,000 to like 150, 200,000 during COVID for some people. So it's nuts.
Thanks to Jason. Thanks to me talking to Jason.
Let's bring it back to the thought experiment. If we know that the tariffs are gonna last for a lot longer, wouldn't that bring back certainty into the market? Not great certainty, like prices are gonna go up, but it's certain that the prices are gonna go up, so people can plan ahead. Like, how would that play out? Wouldn't it be over the long term still a good thing? Maybe not a good thing, but people would be able to figure out through innovation how to manufacture homes for more affordable prices. Like for example, I saw some videos of people using different building materials. Like they use blocks instead of wood frames, and then they fill it with cement. Have you seen that?
Mm-hmm.
And then I saw people like construction companies doing 3D printing home frames.
Oh,
Yeah, so they just
oh
lay down
wow.
like it's like cement, but then they lay it down and it quick dries and they layer, and then they build a wall.
It's like Minecraft.
Yeah. Basically.
Basically. I mean, you can get innovative, and all those innovations have been there, right? And I've seen internet. I know what article you're talking about with the 3D printers, like $500,000 that'll print a house for you, and the guy did it like in
Yeah,
a month,
way
built a whole
faster.
community.
Uh-huh.
Yeah.
Right.
So I mean, where did the 3D printer come from? Because if that was all manufactured overseas with a 400% tariff, that's a $2 million machine now. And then you have materials coming from sand or whatever. Where's that coming from? Right. So it's like,
Mm-hmm.
it's cheap now looking at it today, but it might be 4 times more expensive. So it might still be cheaper to import that wood from Canada. I don't
It
know.
might be.
It's 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 stable in the sense that yes, if we've had those tariffs for 4 or 5 years now, like we would have gotten used to it. But would people want to risk, or would builders even have the appetite to build on those
Well, they
cases?
have to. They have to make money.
Right. But who would be able to
I
People aren't
think
just gonna
afford a
give
house that
up.
expensive at that point? Because then if
Right,
tariffs
I
were
know,
that
but
high, wouldn't our
everyone's
home
gonna
prices
adjust.
go up too?
Everything goes up. Yeah.
So like
they
our
do
existing home
adjust, but
values
at what
would go
cost,
up.
you know? So
Yes.
yeah.
I think you're right. I think existing home values go up too because there's gonna be a massive price shock on everything. If we see prolonged, or we get some sort of certainty from the administration that it is definitely going to be a prolonged tariff regime, is it still good to buy a house? Is it still good to pull out a mortgage? Do they do that sooner than later, anticipating maybe like more tighter restrictions on lending requirements? What do they need to watch out for?
Yeah, absolutely. We always say buy the house if you can afford it, if you are, at least some form comfortable with the payment and instead of renting. So no, you should still absolutely, purchase at a time when you could. Like let's say if you have your significant other with you as well. So if you guys have a dual job and you could look at it as like, okay, if I can withstand it if let's say one person is out of a job for like let's say 3 months, let's say, right? Um, it's something that is definitely plausible. Like don't wait anymore. We just keep saying don't wait. Like there's there's always gonna be economic, surprises. There's always gonna be things that happens in the world, COVID, inflation, all of that. But as long as you get qualified and you can make the payment on it, definitely you should buy the house.
And like Nikki said, and like just like Jack said the other day too, it's like it's got to be a payment you're comfortable with, right? And as long as
Hmm.
and if that payment is comfortable today, and you can buy a house today with that budget in mind, long term, it's a place to call home. That's what buying a primary home is. It's your safe place away from all of this tariff nonsense, you know. And as long as you have your job and your income, and that house in that budget is the one you want with for that payment, yes, I'm all for buying it because again, it's your safe place, right? How safe would you feel renting right now? And then 3 years later, 4 years later, because everything is so uncertain and no new apartment buildings are going up, and the demand for rent is even higher, right? So now your monthly rent might be 3 grand, but now it's 5 grand. And that's happened here in California, right? I think it was like, I remember back in college, like renting an apartment. This is gonna date me, but I remember seeing apartments for like 500-600 bucks next to the college campus. You try to do that now in Irvine, it's probably like what, 5,000 bucks, right? It's gone up 10 times in the span of like 25 years. So it's like you can argue with or think that like you're gonna find a time in the market better, or these tariffs stay and whatever happens, right? But ultimately, like it really comes back down to like if that budget after you talk to Nikki and I and figure out like, look, you can afford 3 grand a month, 4 grand a month, $1,000 a month, will get you this value of a house in your area. Is this exactly what you're looking for? Is this going to meet your family's needs today or tomorrow? Right. So yeah, no, I'd say it's always better to buy sooner rather than later, especially if it's your primary.
I I used to always give this example, like seriously, if you think about it, let's just say like 50,000 more. Really, it's like if you break it down, it's like a coffee a day. Like that's how much of a difference it is. It's a coffee a day. If you can forego one thing so that you can own a home that now you call, for yourself, like it's your family home and you stay there, it's more worth it, because sometimes like we spend money on so much other stuff, right? That really owning a home and you're staying in there, that could be your vacation, that could be your safe haven, instead of being out there trying every different food, trying new restaurants, and then spending all your money on food and stuff like that. Maybe if you just kind of pull back on those expenses, you could own a home.
Right. So in scenario two, when all the prices go up, costs of goods go up, uh, the recommendation is we gotta just adjust lifestyle. We gotta make some smarter financial decisions, make sure our credit is good. Um, don't leave your job, right? um, yeah, I
Be
think,
smart about it, it's like you're
yeah,
gonna be when cost of goods go up, like the your frivolous spending, right? Or it's not petty cash, sorry. What's the term? Like
disposable income.
your disposable income, sorry. Yeah,
Disposable.
your disposable income. It's like you're gonna get tighter with it, because you're gonna see, geez, that egg that used to be 15 cents is now $1.50, and I eat six of them a day, Now instead of it being $1 a day on eggs, I'm spending $7. Or your Starbucks goes from like $8 to $15 for that frappuccino, So you're gonna start making changes, and those vacations and stuff like that, travel. It's not gonna be maybe to Disneyland anymore, but maybe to camping out in Joshua Tree, right? We're
Hmm.
gonna people are gonna start making adjustments. And you're gonna have to
I'm literally doing
prioritize.
that. I'm taking my son out to camping for like $40.
Exactly,
You
exactly.
know,
Yeah.
Death Valley. Actually, I just came back and it's like the most amazing place. It's very fun. I was shocked by that. So when you mentioned Joshua Tree, like camping that way, having different types of vacation, that too, right? It could be there's like actually very, very affordable vacation spots. So
Hmm. This is just scenario two. We don't know if that's going to happen. In my opinion, this is a far less likely scenario. I think, uh, you know, he, I think the tariffs are going to get rolled back pretty aggressively, except for maybe China, which brings us to scenario number three. What happened recently, which is like literally April 10th or April 9th, yesterday, there was an announcement that there's a 90-day pause on all tariffs, on all additional tariffs. I think baseline 10%
Yep.
still on the table, but way better than like 30 or 50 or 60% that he was imposing on a lot of different countries, except for China. China is, it was at 105. The last thing I heard today was 125 now. And China has imposed a reciprocal tariff um, in the hundreds almost, right? I gotta look that up.
I know. I think it was like 104. It jumped from 104, and then they responded with the 84, and then now it's at a 125 today. And then who knows where it's going to be tomorrow or in another 30 minutes. But
Yeah.
it's like it's like two countries playing with tariffs. It's got tariff tantrum problems or something. I don't know.
it's like two, yes, it's like, how could it just like, they just keep throwing out like numbers so quickly? They're not thinking about how it affects like people. Like for them to just keep throwing out these numbers, it's
Yeah.
insane.
Yeah. So I think this is a far more likely scenario than anything else that we've been talking about. Um, and I think this is the most scary situation because in scenario one and two, there was at least certainty that some business people could look at. But when we're in scenario three, which is Cold War II, U.S. versus China, and it's very apparent. It's like U.S. versus Russia back in, you know, uh, when was the Cold War? Was it like the 50s, 60s?
Yeah, I think it was the
Yeah,
60s.
60s. There was a lot of uncertainty. The only certain thing was that there was an enemy out there. Everything like media, everything was geared towards we don't like the Russians. The Russians are all
Spies.
they're all spies. Yeah, the Red Scare, right? We learn all this in the history books. But I mean, aside from all the negative stuff that could happen in terms of people to people interactions, let's just remove that, because that's we don't that's not a good thing, and we don't want that for people. But we're going to be focusing mostly on what's going to happen to our industry. So let me run through the scenario, okay? I'm going to paint a picture for you guys. China, it doesn't want to back down. They see themselves as the global power, and they have aspirations to be number one. US, same thing, same position. They don't want to lose the pole position to China, and both are competing for number one. Okay, US has put out a statement to the rest of the world saying, hey, if you want to do business with China, forget about business with the US. And China likewise has said, okay, if you're going to do business with the US, forget about business with China. And there are now two trade blocks. There are countries that are friendly with the US and refuse to do business with China, and there are countries that are friendly with the US, China, and refuse to do business with the US. In that situation, what I can see potentially happening is definitely the US will onshore national priority manufacturing, like in semiconductors, microchips, pharmaceuticals, rare earth minerals, EVs, green tech, defense, aerospace, all that will come back to the United States. But we're still going to be importing from friendly nations for consumer goods like t-shirts and toilet paper and things that we just can't make affordably here. Now, when we get to the bond market, I think what will happen in the bond market is decrease in the bond market because China and its friends will sell off US bonds, right? Once the bonds get sold off, we're going to see yields go up, which means mortgage rates go up. In this scenario, what do you guys think will happen in terms of the real estate market, mortgage market? Do you guys agree with me, disagree with me? Do you feel like there could be a different outcome?
I don't think it's as simple as that, frankly. It could be like, if you want to do it like just generally speaking and say, assume there's two trade blocks, right? Like, I don't see China being irresponsible and just selling off all of the US treasuries, because like that could be like their gold as reserves in case it doesn't work out. So then now they have all this US debt that is highly valued, right? So I don't think it's going to be a flood of treasuries coming out to push the rates up. But when it comes to two sides of, just generally speaking, of the trade blocks, US and China, I could see some of that happening, because like look at Rocket Man Elon, right? He disrupted that whole process of SpaceX, satellites, rockets, and all of that's primarily manufactured now here in the US at significantly lower costs, right? So out of his like 100 and something rocket launches, I think that those launches combined probably cost less than what NASA and all their other DoD contractors made with like all the Apollo missions. So I think there's definitely, like in those types of high tech industries, there's going to be a room for innovation, right? And they're going to, and other entrepreneurs like Elon and whoever, they're probably going to see those opportunities, right? Identify it. And then it's definitely, like you said, those low level manufacturing jobs, it's going to come from somewhere else. It's much cheaper to bring those and continue to produce those goods. Who knows where it's going to come from? But like EVs, minerals, Greenland, right? Ukraine, rare earth minerals. Like we're going to have, I could see that scenario playing out.
Yeah, because Greenland is, they have a lot of natural minerals, rare earth minerals, right? So if US and Greenland had closer ties, I don't know about making them a state, an official state of the US, but let's say like basically what Puerto Rico is to us.
Like Ukraine, they want the war to stop at Ukraine so they can go in and recoup their investment, right?
If they onshore more and more of those industries back to the United States, we're going to have higher paying jobs, which is kind of one of the goals of Donald Trump or the Trump administration, right? So higher paying jobs, which means people will have more income, which means better for the housing industry, no? Because there would be
Should be.
more people, more qualified individuals.
It's like back in the cold, like post Cold War too, right? Home, like the average wage versus like well, still industrial because they were manufacturing all of those wartime era needs, right? Which is in that time very high skilled manufacturing jobs like airplanes, tanks, weapons, and stuff like that. It's a long play, but man, it's just gonna be a painful 20 years to get there, you know? And that's our kids' generation actually. Like what are they gonna be doing?
Yeah.
Yeah, definitely. I agree with that. Short-term pain, but potentially there could be some
Prolonged.
long-term benefits. Nikki, do you have any perspective on this?
Yeah, I think that, if we look at it from his perspective, it's a long haul, and but how much can Americans take, right? Do they really like pain? Can we withstand pain? I mean, yesterday just happened. He just, kind of right back down on the tariff. So why did he do that? Is it because people already they're not liking it? Like that this 2 week
Yeah.
time, he's already backing off a little bit. Like, are we really gonna be able to get to that point, right? 5 years, 6 years, 7 years of pain to bring back all the jobs.
Because like if he really executes on what he's trying to do, it's gonna be a decade of
Hmm.
pain. Like that's how I feel looking at it. So it's like everything I'm doing now, I'm not going to the point where it's like we're fighting for toilet paper at Costco and trying to
Hmm.
make that kind of rush. But like for me, it's like I hate uncertainty, you know, and like with our cut, like with clients here too, like with and mortgage, you hate uncertainty because like say for example, like it makes me feel so bad because like last week Thursday and Friday, I saw rates coming down and I saw the window of opportunity was there and I reached out to all the clients that I knew had benefit of refinancing, right? As an example. And then lo and behold, Monday hits. It reverses, right? This is what's crazy. It's only been 4 days, right? Or about 4 business days. But the low in Thursday and Friday was a low in in rates compared to like similar to what was October of last year, 6 months ago, right? 4 days later, today we're back to February rates. That
Hmm.
swing, 4 days, we've seen 4 months worth of trend back up. So it's like that uncertainty is gonna wreck our industry. So those capital markets departments are like, do we even want to lend, right? How do we make it more stable for our business to stay in business? You know, like
Hmm.
if you wrote a loan on Friday and you sold that loan today because it closed, that loan is not worth what it was Friday.
Yeah, yeah. The
And
arbitrage is
with
crazy.
And with rates, it's like we're locking in a rate right now. That doesn't mean that the bank is actually, banking on that rate right now. It's, once it closes, they're actually just kind of securitizing what it would be, let's say 30 days, right? Because the 30 days, if the rates are up, they'll actually have to eat the difference in that, right?
To like the average viewer too, right? It's like think of it this way: like every lender out there, bank, direct lender, broker, whoever, right? That loan that they fund for you may have cost them $100 to make today, right? But every business, like every American, you don't have an infinite amount of money. You're paying interest, right? So if the markets continue to seesaw like this, what's going to happen in my eyes is a lot of lenders will just stop lending, or it's just the cost to lend has to be worth that risk now to lend you that money. So either lenders don't lend that program anymore, they're going to cut products, or it's that cost for that product is going to go up.
Do you have closing thoughts for our audience, whether there's a lot of noise in the market or not a lot of noise? What's like that one thing that they should be focusing on?
I would say if the lender qualifies you on their debt to income ratio, right? Don't be afraid to push yourself to even a little bit higher payment to buy that bigger home than what your comfort level is. Because, a lot of times people think that they can only afford one amount of payment, but then to come out of it, they feel okay, after being in the mortgage. Basically, instead of spending money on frivolous stuff, now you're spending on a home that's going to grow in equity, that's going to grow with your family, instead of settling for something that you thought your payment is at a certain level and that you cannot go higher than that. I always say, push yourself a little bit to buy that home that you're going to stay in for a long period of time, rather than to kind of keep it at the comfort level, because you're going to be a year from now, if rates drops, then you're going to reduce down on the payment. You're going to say, darn, I wish I would have bought that bigger home that I was eyeing on, just because I was afraid to pay $500 more per month on the mortgage, which, right now, $600 gets you about $100,000 more. And think about how much more of a house you can buy with $100,000. Actually, it's a pretty big number. So I say, don't be afraid to push yourself to that push your comfort level for a higher payment when you're buying a house, because the lender is actually qualifying you on a higher amount. So push your limit.
Don't be afraid of a monthly payment that you know you're qualified for, because no matter what a lender tells you, like literally for most conventional loans, Nikki, generally speaking, our guidelines say 43 to 45%, right? And in some cases, if you have compensating factors, it's 50% of your gross income. So it's like you have runway. It's just a matter of like lifestyle choices you want to make. Personally, I feel the most comfortable when I'm at like 30% housing expense. And then I can still invest and save and do other things with my money. But like some markets, you're going to find phenomenal deals right now, an opportunity, especially with home values coming down as much as they have in certain regions, back to like, I would say almost pre-pandemic levels. You're going to have a good opportunity to see future equity in that, or in terms of appreciation and really fair payments right now. It's going to be, I think, a good deal.
For me, I think we really, really want to talk about long-term perspective. Real estate, housing is not like the stock market. Stock market moves very quickly. Real estate moves more very slowly. But in certain conditions, like what we're seeing now, it's moving very fast, right? We're seeing prices in certain areas dropping like 20%, 30%, which we normally typically don't see. And I feel like if you have the ability to get deals and close, like what Jason and Nikki were saying, definitely be on the lookout for these great deals that are coming up, and be open to relocating, be open to driving a little bit further. A home is one of the biggest and most important long-term assets that any normal American can get into. So definitely consider that and put that on your priority list. All right, that's it for today's episode. Thank you guys for joining in. We had a lot of fun running through these different scenarios. It sounds very bleak and scary, but it's a lot of noise. Ultimately, when we're talking about real estate, when we're talking about mortgages, the market does move, but generally it moves up, right? So if you guys need help with strategizing, if you need one-on-one consulting, click that link in the description below. And we have the same link in all of our socials: Instagram, TikTok, we're on Spotify, Facebook. So please connect with us, drop a comment and subscribe. Let us know what you think of what the tariffs are doing and what's going on in your neck of the woods. So that's it for us today. We'll see you guys in the next one. Bye-bye.
See ya.
Bye.